This is my personal opinion, based on widely accepted financial principles. When it comes to retirement, the first 5 years often matter more than the next 30 combined. Early losses in the market and initial inflation can permanently change the trajectory of your portfolio in ways that later challenges rarely do. Understanding this concept is critical to designing a retirement plan that survives both good and bad market conditions. Studies from Morningstar, Vanguard, and Investopedia highlight that retirees who experience poor market performance or high inflation during the first 5 years of retirement are at significantly higher risk of portfolio depletion. This is not about reckless spending or overly aggressive portfolios. It is about the timing of returns. Retirees who start retirement during favorable market conditions and maintain disciplined, inflation-adjusted withdrawals have dramatically lower failure rates. For example, research shows that portfolios facing early losses are far more likely to experience permanent reduction in lifetime wealth compared to portfolios that experience volatility later in retirement. Monte Carlo simulations conducted by Morningstar illustrate that even with a reasonable withdrawal rate of around 3.4% and a standard 30-year retirement horizon, about 10% of retirees still face portfolio failure. Among these failures, nearly 70% experienced losses in the first 5 years. This clearly shows that sequence of returns risk is one of the most important factors in retirement planning. Why are early losses so damaging? The key lies in the mechanics of withdrawals. During the accumulation phase, investors buy assets regularly, so temporary losses are offset over time. In retirement, withdrawals are mandatory to fund lifestyle expenses. If the portfolio suffers a loss early on, retirees are forced to sell more assets to maintain the same spending, which reduces the base capital that could have grown in subsequent years. Even if the market recovers later, fewer assets participate in the rebound, which compounds the problem. Sequence of returns risk explains this phenomenon. The order of returns, not just the average returns, matters. Retirees who experience early gains build a cushion that reduces failure risk. For example, those who survive the first 5 years with positive growth and continue disciplined, inflation-adjusted withdrawals may see failure rates drop to around 4%. Early success strengthens the portfolio in three main ways. The portfolio balance is larger, withdrawals become smaller relative to total assets, and volatility later in retirement carries less risk. Market swings in later years simply have a smaller impact once the portfolio has survived the danger zone of the first 5 years. Starting retirement with a balanced allocation of 30 to 50% equities reduces risk during the early years. Bonds act as shock absorbers, cushioning the portfolio from deep market drawdowns. This is not about being conservative forever, but surviving the first 5 years intact. Once the early years are navigated safely, a retiree can gradually take more risk. This approach aligns with the concept known as the reverse equity glide path, where equity exposure increases over time instead of decreasing immediately at retirement. Adapting withdrawals based on portfolio performance can significantly reduce early failure risk. Flexible spending strategies, such as guardrails, temporarily skipping inflation adjustments, or probability-based spending reductions, allow retirees to adjust lifestyle expenses during market downturns. Even small temporary reductions can dramatically improve the long-term sustainability of the portfolio. Social Security or other guaranteed income streams provide stability. They reduce reliance on the portfolio during market downturns, allowing withdrawals to remain smaller relative to total assets. For example, a household receiving $4,000 per month in guaranteed income and withdrawing $2,000 from the portfolio can reduce the portfolio withdrawal by 50% in a downturn, and total income would only drop from $6,000 to $5,000, a manageable 17% reduction. This defensive strategy protects the portfolio from early losses. Delaying Social Security claims may further enhance retirement security and protect against sequence of returns risk. Allocating cash or bonds to cover the early years' expenses ensures that retirees are insulated from immediate market shocks. Risk assets in the long-term growth portion of the portfolio are given time to recover. This strategy does not rely on market timing, but rather on careful planning to buy time and manage risk. Early inflation is particularly dangerous. A high inflation period in the first few years permanently increases the baseline cost of living. For example, a $40,000 lifestyle in 2020 might cost $50,000 in 2025 due to inflation. Once this higher cost is set, it persists for the rest of retirement. Portfolios relying heavily on withdrawals feel this pressure most acutely because they must sell more assets to maintain spending levels, exacerbating sequence of returns risk. Guaranteed inflation-adjusted income, such as Social Security, reduces pressure on the portfolio and enhances long-term security. The first 5 years of retirement are critical. Surviving this period dramatically improves long-term portfolio sustainability. By combining lower early volatility, flexible spending, guaranteed income, and time segmentation, retirees can navigate the most dangerous period of retirement with minimal risk. Retirement planning is not only about chasing high returns, but ensuring resilience during the first 5 years, which forms the foundation for financial security over the entire retirement horizon. If you found this video valuable, please like, comment, and share it with your friends and family. Subscribe to the channel to stay updated on future educational content. Thank you for watching, and see you in the next video with a new topic.